Investing can be overwhelming, especially when you're faced with choices like stocks, ETFs, and mutual funds. Each one has its pros and cons, and the best option for you depends on your financial goals, risk tolerance, and investment style. In this video, we'll break down the key differences between stocks, ETFs, and mutual funds, so you can make an informed decision about where to put your money. By the end, you'll have a clearer understanding of what's best for you. Let's dive in. First, let's talk about stocks. When you buy a stock, you're purchasing a share of ownership in a single company. This means you own a piece of that company and can benefit from its growth through price increases and dividends. The main advantage of stocks is their potential for high returns. If you pick the right company, your investment could grow significantly over time. However, investing in stocks also comes with risks. Since stocks represent individual companies, their value can fluctuate widely based on company performance, market conditions, or economic factors. Stocks require more research and active management, as you need to evaluate each company and decide when to buy or sell. If you're comfortable with taking on more risk for the chance of higher returns and are willing to put in the work to research your investments, stocks could be a great option for you. Next, let's move on to ETFs, or exchange-traded funds. ETFs are investment funds that are traded on stock exchanges, much like individual stocks. They typically track an index, such as the S&P 500, and are designed to provide broad exposure to a particular market, sector, or asset class. The biggest advantage of ETFs is diversification. Instead of investing in one company, you're investing in a collection of assets, which spreads out your risk. ETFs are also highly liquid, meaning you can buy and sell them throughout the trading day. They often have lower fees compared to mutual funds, making them a cost-effective choice for many investors. ETFs are ideal for people who want a hands-off investment approach. Since they track an index, there's no need to pick individual stocks or constantly monitor the market. If you're looking for a low-cost way to diversify your portfolio and don't want to spend a lot of time managing your investments, ETFs might be the best fit for you. Finally, let's discuss mutual funds. A mutual fund pools money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. Unlike ETFs, mutual funds are actively managed by a professional fund manager who makes decisions about what to buy and sell. One of the main benefits of mutual funds is professional management. You don't need to worry about researching individual investments because the fund manager handles it for you. Mutual funds are also great for diversification, as they invest in a wide range of assets. However, mutual funds often come with higher fees compared to ETFs because of the active management involved. Some mutual funds also have minimum investment requirements, which can be a barrier for new investors. Additionally, you can only buy or sell mutual fund shares at the end of the trading day, which makes them less flexible than stocks or ETFs. So, which is best for you? Stocks, ETFs, or mutual funds? It depends on your investment goals and risk tolerance. If you're comfortable taking on higher risk and enjoy researching companies, stocks might be your best bet. If you prefer a low-cost, hands-off approach with built-in diversification, ETFs are an excellent choice. And if you value professional management and are willing to pay higher fees for it, mutual funds could be the way to go. It's also worth noting that you don't have to choose just one. Many investors use a combination of stocks, ETFs, and mutual funds to create a balanced portfolio. For example, you might invest in individual stocks for high growth potential, ETFs for broad market exposure, and mutual funds for specific sectors or professionally managed strategies. To recap, stocks offer ownership in individual companies and the potential for high returns, but they come with higher risks and require active management. ETFs provide low-cost diversification and are great for hands-off investors, while mutual funds offer professional management and diversified portfolios at a higher cost. Remember, there's no one-size-fits-all answer when it comes to investing. The best choice depends on your personal financial situation, goals, and how much time you're willing to dedicate to managing your investments. If you're just starting out, consider your risk tolerance and how involved you want to be in the process. If you found this video helpful, give it a thumbs up, subscribe for more investing tips, and share it with anyone who's trying to figure out their investment strategy. Let us know in the comments which option you prefer: stocks, ETFs, mutual funds, or a mix of all three, and why. Thanks for watching, and I'll see you in the next video.